Hi everyone, welcome and thank you for joining us today. My name is Jane Hewitt and I'm the Capability Building Coordinator at Connecting Up and TechSoup New Zealand. Connecting Up and TechSoup New Zealand are part of the Info Exchange Group, a not-for-profit social enterprise that tackles the biggest social challenges through the smart and creative use of technology. For those of you who haven't attended a webinar session with us before, Connecting Up and TechSoup facilitate an annual training program of webinars, boot camps, workshops and webcons to help the social sector upskill in all things digital. And you can check out our program of events on each website. So welcome today to the webinar, Why Cashflow is Important for Not-for-Profits with Mick Devine from Calxa. Before we begin, we'll start with a bit of housekeeping today. All lines are muted, so if you have any technical issues, please type them into your questions panel on the GoToWebinar panel, and I'll be able to assist you. And if you have any questions, please type them in, and Mick will answer them throughout the webinar or in the Q&A at the end of the webinar. And if you're on a Wi-Fi connection and have multiple programs open, please could you close any programs you're not using, as this can sometimes affect the quality of the video. Please note that this webinar is being recorded, and I'll be sending out the slides and the recordings to everybody on the list at the end of the day. And before I start, I'd just like to ask you all if you could please fill in the survey that will pop up at the end of this session. It would be much appreciated. So that's all from me. I will pass you over to Mick to get things started. Thank you.
Thanks, Jane. Good morning, everybody. Welcome. So what we're going to do today is have a bit of a discussion about cash flow and cash flow forecasting and why it's important for the not-for-profit sector in particular. And I think the short answer is that it comes down to survival. And so we'll talk a little bit about solvency and requirements there. We'll talk about insecurity, uncertainty, planning for different scenarios, a little bit of a case study story about one of our past clients, and then I'll give you a quick overview of how you can use Calxa to create a cash flow forecast reasonably easily based on the information you've already got in your accounting system and your budgets. So let's make a start. So solvency is about the survival of the business. Do we have enough cash to keep going, not just today, but into the future? And much like the directors of a business, a company, board members of a not-for-profit organization have similar responsibilities, legal responsibilities, that they mustn't trade while insolvent. And I know there's been some relaxation of those rules during the COVID crisis, but the general principles still apply. If your business doesn't have, if your not-for-profit doesn't have the cash to keep going, to pay its debts as and when they're due, it needs to come up with some sort of rescue plan or ultimately potentially cease trading. So, and I think it's important that this is something for all directors, board members, not just the treasurer, not just the CEO. You know, and I find particularly in the not-for-profit sector, people get to be board members on not-for-profits without necessarily having good financial knowledge, because they're recruited to the board for their other skills, their commitment to a cause, their knowledge of the particular sector you're working in. But regardless of that, every board member shares in that responsibility to make sure the organization's not insolvent. And the best way to do that is to have some prediction of what cash is going to be available next month, the following month, the month after, etc., so that you know you've got enough to pay the bills, pay the taxes, etc. and you know, not-for-profits may not pay tax on everything, but there's still GST to collect, there's still GST credits to apply, there's still PAYG to remit to the tax office, that sort of thing. So I think it's really important that directors and board members of not-for-profits have good knowledge of the finances of their organisation. They can't just glance at a monthly financial report and say they didn't understand it, or they didn't read it, or they didn't have time. They need to actually look at those numbers, and I think that puts a responsibility on the finance team in the not-for-profit organisation to present information to the board members in a way that's understandable to them, that doesn't require a degree in accounting. You know, you shouldn't have to have a degree in accounting to be a board member. The information should be presented in an understandable way, but it's important that it's read. And then I think it's important that as a board member, you understand the systems that are in place to control the finances, to manage the finances, to make sure that there's integrity to them. It's important to also ask the right questions. You know, when something does seem odd, something doesn't fit with the pattern, something's unusual, it's about asking the questions and not sitting there quietly and leaving it all to the treasurer or the CEO. And I've seen that happen far too many times. And directors and board members should have directors and officers insurance to make sure that they are covered in the event of any financial problems, but that will still require that they've carried out their duties diligently. And I think there's nothing wrong with the members of a board seeking external advice sometimes as well. You know, it's bringing in an accountant to talk to them, to explain what's happening, and an independent view. You know, it could be the regular auditor, it could be somebody else, but it's about being informed as a board member and understanding the cash position of the organisation, both now and in the immediate future. And I think even more in 2020 than normal, funding for not-for-profit organisations is more insecure than ever. I mean, you know, I don't think there's ever been a golden age when, you know, every not-for-profit organisation knew what was happening for the next year, 10 years or whatever. There's always been some uncertainty, and you know, to some extent governments have helped that by, you know, doing 3-year funding commitments and that sort of thing. But even then, at the end of the 3-year period, you've still got uncertainty there. There's often shorter periods. There's grants that cover 6 months periods, 12 months periods, and those government funded grants, they're always subject to changes in political direction, in the preferences of different governments, different ministers, what's popular in the media at any particular time. And sometimes as a not-for-profit, you can be the beneficiary of that, but other times you can lose funding because it's been diverted from your sector to some other sector. So, and then those who rely on donations and also the sale of goods and services, both of those are very much reliant on people having disposable income. And in any sort of economic downturn, any reduction in people's ability and willingness to spend, to donate, then that impacts the funds available for your not-for-profit. So there's, you know, all sorts of different scenarios on how that can happen. You know, membership fees are, are probably generally one of the most stable, because they're you know, you have a regular number of members who contribute month after month, year after year. But this year has shown that, you know, I've spoken to quite a few sporting clubs this year who, because of COVID shutdowns, had to stop collecting membership fees from their members and that sort of thing. So, you know, there are different levels of uncertainty for different types of organization, and it affects all organizations regardless of size and sector. So given that funding is insecure, I think the important thing then is to manage it, and managing that uncertainty is about looking at the information you do have. What do you know? What can you predict? And I think when you're predicting the future, theoretically, you know, there are millions of possible futures, but we know that some are more likely than others. Not many of us at the beginning of the year were predicting total lockdowns for weeks on end, but obviously these are things that are possible, even if unlikely. But even coming out of a lockdown type scenario, there are different possibilities about whether recovery is quick, recovery is slow, or something in the middle. And I think it really helps to go through some of the different possibilities, to talk them out amongst the team, to draw things on a whiteboard, to discuss how you would react to different options, and draw up plans. And so I think it's about just working through different scenarios, thinking about what your organization would do if this happened, if that happened, and then putting numbers to that and looking at the effect of different scenarios on your cash flow. And it's about looking at, you know, some scenarios, like my green line here, is bad for my cash flow in the short term. It takes a big hit and then it bumps along the bottom, but then it recovers in the longer term. Whereas my yellow line here is good in the short term, but then it has a longer, slower decline, which is still going downwards in 12 months' time. And, you know, different scenarios will have different cash flow patterns. There'll be some things that require you to spend money now, some things that where you'll be able to save money now and spend it later, some where you'll have income in the short term but not in the long term. But you need to map those different options, and I think by looking at the different scenarios, looking at the different opportunities that might be open to you, you're then in a better position to react quickly when you need to make decisions in a hurry. And I think understanding the cash flow effect of those different options is really important for the sustainability of your organization, to make sure it's going to have the funds regardless of what happens, to get through the next few months or years. Now, things don't always turn out well, and I want to tell a bit of a story about a client that we dealt with a few years ago now. It was 2015 when they closed down. This was Metro Screen in Paddington in Sydney, and they'd been providing film and production training and facilities for close to 30 years in Paddington, but they were largely funded by Screen Australia, and there was government policy changes at the time. Again, as I said, you know, grant funding is subject to the whims and fortunes of government, and they lost a big chunk of their funding. They spent 6 or 8 months looking for alternate sources of funding, looking at different options of how they could get money, how they could keep the organization going, whether on a smaller scale than previously or potentially grow it. They looked for private sector funding, they looked for different government funding, but in the end, they weren't able to get the funding they needed. But because they were forecasting their cash flow every month, they knew that they had enough to keep them going till December, but after that, they would reach the crunch point and not be able to pay their debts. So they decided in August of 2015 that they were going to close down at the end of December, and they would wind down in an orderly fashion, pay all the suppliers, pay all the staff and their entitlements, and then pass on whatever assets were left over to another organization. So it wasn't a happy ending in the sense that, you know, the organization survived. It didn't, but they closed down in a planned and systematic way so that everybody got paid. There was no crisis. Yes, people lost their jobs, but they had time to think about it and time to look for other things, and they got their proper redundancy payments, etc. And they wouldn't have been able to do that if they hadn't been forecasting their cash flow. So I think it's that knowing what cash you've got available, how long it's going to last you, and really using that information as part of the planning in your organization so that you manage either growth or, as in the Metro Screen case, a shutdown. We all hope that we don't end up in the shutdown scenario, but far better to do it in a planned and orderly way than have administrators turn up and lock the doors one day and send everybody home without pay. So just think about that. Think about how you manage your cash flow in your organization. And now I'm going to have a glass of water. I'm mouthful anyway. Jane, do we have any questions at this stage?
No, not at the moment.
No. Okay, in that case, maybe we could just quickly do that poll that we prepared. And what I want to know here is what accounting system is everybody using? If you could just answer that, that will help me with the next section of the presentation and make sure I cover everybody's needs. And So what I just got to make that. Oh.
Can you
Sorry,
see
I've
that?
got to make. Yeah, it's just a bit small on my screen. That's all. I'm trying to make it a bit bigger. Yes. Okay. So 33% MYOB account right, 44% Xero, 11% QuickBooks Online, and 11% something else. Okay. Let me talk about cash flow forecasts with that in mind, and let's keep going. So I know I've spent the last 20 years banging on about cash flow forecasting, and until fairly recently, I think it was something that many not-for-profits didn't do very well. Some have done, some haven't, but to some extent, if you're grant funded permanently and you've got long-term contracts and you know that you're going to get $20 million every 6 months from some government department, then the cash flow forecast is reasonably simple. You just have to make sure you spend less than $20 million and you'll be fine. But as I said, times are more and more uncertain these days. The whole change in disability sector towards consumer directed care with the NDIS and similar changes in aged care and home care, those sort of things, they provide less certainty to not-for-profit organizations on their funding. So I think more and more people are interested in cash flow now, and I want to take you through the simple steps that we do in Calxa to produce a cash flow forecast. I've done cash flow forecasts in spreadsheets before, many years ago, and I know it can be challenging, and I'm sure that's the main reason that many organizations haven't done cash flow forecasts or not done them regularly. But there's three main components you need to create a cash flow forecast in Calxa. You need the profit and loss budget, which most of you, I'm sure, are familiar with. Calxa connects directly to MYOB account right, Xero, QuickBooks Online. So that covers 89% of you here today. The other 10%, we do have an option to create a manual organization within Calxa and import your data from a spreadsheet or a CSV file, which you've exported from the other accounting system. Not quite the same seamless process as the direct integration, but it works and we've got plenty of people doing it. So you need the profit and loss budget, and most of you, I'm sure, are familiar with creating one of those. And then one of the important things for cash flow is managing the timing of payments and receipts. When do you pay your GST? When do you pay your PAYG or PAYE for those of you in New Zealand? When do you when you record when you record expenses and income in your accounts, when do you actually receive it? So that timing is a big factor in a cash flow forecast. And then the other important part is the balance sheet side of things. What capital purchases are you going to be making? And what, when you receive grants, often you'll receive them to a liability account and then journal them monthly to the income account. you need to make sure that's handled correctly in your cash flow forecast. Some of you will have loan repayments, etc. And so in Calxa, we calculate a lot of the complex accounts in the balance sheet. So we calculate GST, debtors, PAYE, creditors, etc., and the bank account. So we make that part easier for you. And then it's about presenting reports to your audience. You know, especially if you've got non-financial people in your board, I think it makes sense to use charts more than numbers. If you are using numbers, summarize them for board members so that they don't have to have every single line of detail, and put those reports together and schedule delivery of them each month. Now, I've just got a quick question here from Dana. I'll just give me a second to read it. Small not-for-profit employing one permanent part-time worker, contract external bookkeeping to prepare financial reports. Board meets monthly and prepare a brief financial analysis of financial position of organisation. Plus, boards receive updated budget, profit and loss balance sheets. Is this good enough? I think it's almost good enough. I think I would add a cash flow forecast in there as well. To some extent, if you've got the profit and loss and the budget and the balance sheet, you could derive a cash flow forecast. But you know, if you're an accountant, you could do that. But I would add a cash flow forecast in there, and I'll show you in a second how that's done in Calxa. And we do have a donation program through our friends at Connecting Up and TechSoup. So if you're a small or medium not-for-profit, talk to TechSoup if you're in New Zealand, Connecting Up if you're in Australia, and get the donation of Calxa, and you'll be able to do a cash flow forecast fairly easily. And let me just show you those steps to give you an idea of how it works. So I might just switch companies here. Now, this one I've got connected to Xero, but the principle's the same, whether your accounts are in Xero, MYOB, QuickBooks, or something else. Once the data's in Calxa, the process is the same. And as I said, the first thing you need is a P&L budget. And with our budgets in Calxa, you can budget at the program level. So that's, you know, tracking categories in Xero, jobs in MYOB, classes in QuickBooks, etc. And they'll automatically roll up to the organization level budget. So you don't have to maintain that separately. And you can budget for up to 20 years ahead. What I would suggest that as a minimum, budget for the current financial year and the following one, so that you can do a 12-month forecast at any point during that period. So you can put your profit and loss budget into Calxa. If you haven't got an existing budget, and I know some people do, some people don't, we have a budget factory wizard which will take last year's actuals. If I just quickly just show you, if I just select all there. So you can take last year's actuals and create a budget for this year and next year. And even if you've only got a budget for the current year, but you want a quick draft for the following year, use the budget factory to do that. And then you can say, you know, this year we're doing a 4% increase in income and cost of sales, 2% for expenses, and different percentages next year, etc. Yeah. and then go next. And then if you save that, you've very quickly got a draft of next year's budget. Those of you who've got existing budgets in a spreadsheet, you can import those. You just export a template from here, import it back in again. I'm not going into all the technical details, just want to show you the principles of what you can do. And then you can edit the budget in, excuse me, in Calxa from there on. Now, the cash flow settings, as I said, manage the timing of everything. So when do you pay GST? And we've got different schedules set up. And I know back in 2000 was when GST was introduced, I got myself into lots of circular references in my spreadsheets trying to do cash flow forecasts, including GST. But when you've got a computer program to do it, it's a lot easier, and some clever software developers. But anyway, so in Australia, you would choose monthly, the standard quarterly, or the quarterly with the tax agent extension. In New Zealand, you're probably on one of the two monthly options or one of the 6 monthly options. They're all there, and do you do it on a cash or an accrual basis? Similarly with wages, the average amount of tax that you withhold. So for that, I normally run a payroll report for 12 months, divide the tax by the gross pay. That gives me an estimate for that organization. And then when do you pay the PAYG or PAYE to your tax office? And then similar stuff with superannuation. And the main cash flow settings, if I bring this up, I'll just go to the basic view. What we do for the timing of payments and receipts is that we look at the average debtor days, average creditor days in the accounting system, and we recalculate that every time we synchronize. So in this case, average debtor days is 14. So we're assuming we collect our income 61% the current month, 39% the following month, whereas this organization's pretty slow at paying their suppliers with an average of 112 days. So most stuff getting paid in months 3, 4, and 5. Now, that's the simple basic settings, but you can override this globally and say, you know, what if our creditors start squeezing us and we have to pay in 50 days, and it gives you a different profile. Or in the advanced view, you can pick individual accounts. And if I go and find an income account, so if for example, I had a grant that I was journaling from a liability account each month, excuse me, and so then I don't want the budget that's on this account to affect my cash flow forecast. So I then set this account to being none because the income there comes from a journal. And then in the liability side, I'll have my grants received in advance, which let me just unselect the other one first. Otherwise, I'll confuse myself. So let's go to the liability side. So grants received in advance, that's 100% in the current period. So whatever I put in the budget against that liability account is what I'm going to see on my cash flow forecast. And the allocation I've set to none because that's only managed by the journal. So there's fine tuning you can do there beyond the basic settings to make sure that timing happens correctly, depending on how you're accounting for your different income, expenses, etc. And then the balance sheet budget, as I said, is important. If I just go to one of these, so In Calxa, you'll find the balance sheet accounts down below the profit and loss accounts. And as I said earlier, you don't need to budget for things like bank, debtors, creditors, GST, PAYE, because we calculate those based on everything else that we've got. So what you're then budgeting for is the movements in all your other asset accounts. So in this case, I've got $20,000 going into a short-term investment account in January and 10,000 of it coming out in March. I've got a plant and equipment purchase in December of 20,000. And then on the liability side, I've got a loan repayment there, that sort of thing. And so your grants in advance would be done on the liability side there. So, you know, maybe I'm receiving 120,000 in July, and then the allocation of that goes at 10,000 a month, which then gets allocated to the income account. And that's the basic setup for a cash flow forecast. And once you've done that, it's then really easy to just produce a set of reports. And we actually have in our report bundles a three-way forecast bundle, which, let me find the right company, find the right budget, create that bundle, and then I can run this bundle of reports, and it's got a set of charts and a set of reports with numbers, because some people need the numbers. Somebody in the finance team needs to tick and check and make sure everything makes sense. If I just pop that out to another tab, just to give you an idea of what you can do. So this is my net profit month by month for the next 12 months. The profit and loss forecast showing our income and expenses. And, you know, as a variation on this report, you can do it showing actuals year-to-date budget for the rest of the year and compare it to the full year budget as well. Let's just scroll down through there. And then the balance sheet forecast. Again, it's important to know what's happening with the balance sheet. So my total assets, total liabilities, net equity, and, you know, as a board member, I want to see that generally that net equity should be increasing as we're building up reserves. You know, there's periods where we may spend those reserves because we've accumulated them for a particular purpose, and then it may go down, but that's, you know, and again, the balance sheet, and I was pleased to see Dana's giving her board members a balance sheet report, but, you know, you just have to be aware that, especially the non-financial people on the board, that they may not always understand what a balance sheet is, and I always find good with balance sheets to do some sort of comparison. You know, in this case, it's got the opening balance, which has come out of the accounting system, and then each line projected forward 12 months. And, you know, sometimes when I look at a balance sheet, I compare it to the beginning of the financial year. Sometimes I'll compare it to the same month last year. But I am, for my sins, an accountant, but even I sometimes, you look at a balance sheet in isolation and it's hard to know what's good, what's not good. Whereas if you've got something to compare it to, you can look at the changes. And when I do a three-way forecast like this, I'll generally look at the you know, what changes are happening in each of these accounts over the next 12 months, and are they reasonable? You know, our accounts receivable starts off at $75,000, goes down to 22,000. At one point it's 108,000. That suggests some volatility in the income there, and I would go back and look at the profit and loss projection and see whether that matches up with that volatility and if that makes sense. So use it as a reasonableness test. And then we've got the cash flow forecast itself. And this one does look a little bit sad, doesn't it? So the black line is the predicted bank balance month by month for the next 12 months. The bars are the different components. So green's income, red's liabilities, so that'll be GST, PAYG payments. The dark blue is expenses, the pale blue is asset movements, and there's a little bit of yellow there for cost of sales. Just see, excuse me, so you can see what's influencing the ups and downs there. And then that same thing with numbers, which has come from those budgets. So actuals up to the end of last month, budgets for the future months, and all adjusted for those cash flow settings that we put in for the timing. So these income numbers include GST, and so do the expenses. It shows the net wages each month in the cash flow forecast there. We've got those movements in and out of our short-term investment accounts, some plant and equipment purchases there, some loan stuff. Then my GST in this case is quarterly, and my superannuation is quarterly on a different schedule. And then net movement and bank at the end. So it's simple stuff once you've done it, but it's quite complex stuff to do with in a spreadsheet. So do have a look at Calxa and see whether it'll work for you. As I said earlier, we do have a donation program for small and medium not-for-profits and charities through Connecting Up and TechSoup, and there's a discount program for those who don't qualify for the donation. Does anybody have any questions?
Not so far. Anybody?
Last couple of minutes, last chance to ask some questions.
No, just a couple of people saying thank you.
Okay, thanks for attending.
Does it work with MYOB Advanced from Carrie
Not
Butler?
directly, but you can create a manual organization in Calxa. You need to put in your chart of accounts, and you can import the actuals from a spreadsheet or a CSV file each month then. So what our customers are using it advanced, I think they're exporting a trial balance out of advanced each month and then importing that into Calxa to get the actuals in.
Okay.
So not quite the same process as the direct integrations, but one day we may do a direct integration with advanced. It's something we've talked about, but ran into complications, and it's still in the plans.
Great. Compared to QB in terms of security, I don't know quite what that means.
In terms of security, Calxa's data is stored in Microsoft's data centers in Southeast Australia. We use a lot of their security tools to prevent, to alert us to any sort of intrusion sort of attacks, that sort of thing. We are about to introduce in the next week two-factor authentication. So, we're regularly reviewing and improving the security features because the world becomes more dangerous every year. We actually get an audit from QuickBooks and from Xero every year on our security features, and they generally come up with some recommendations of things to improve, and we follow through on those because they make sense. And you know, there's always new technologies that you can use, new ways of preventing threats, of detecting threats, that sort of thing.
Excellent, thank you. We've got a couple of minutes left, but just thank you everybody for joining us today, and thank you, Mick, very much. That was really informative. We've got one more question. Does it work well with multiple departments or business units, or just get consolidated reports?
Yes, it works very well. And that was probably that's probably where we started off many years ago, doing better job reporting and budgeting for MYOB users. And so you can do reports at that department or business unit level and consolidate them up to the organization level. You can even consolidate multiple companies if you've got, you know, multiple MYOB files or multiple Xero files, or even a Xero file plus a QuickBooks file plus an MYOB file. It all works.
Excellent. Okay. So as I said at the beginning, we'll be sending the recording and the slides to everybody at the end of today. And I can include your email on that email if you'd like, Mick, so people can get in touch.
Yep.
So
happy to chat if anybody wants anything. Yeah.
Excellent. Thank you everybody for joining us today, and do keep an eye on our website for upcoming webinars. We've just published a few more for November, December and February. So thanks once again, and stay safe. Goodbye.
Okay, thanks everybody.